Alrighty. So, what is the safest way for you to make your first $10,000 trading options as a beginner? So, if you're new to trading options, or maybe if you haven't been consistently profitable, you're struggling to make options work for you, then I want you to really pay attention to what I'm about to say in this video because it can save you a lot of money and also to save you from the destruction that many new traders get themselves into when they are trading options. So what is the safest way? So in my humble opinion, if you are struggling to be profitable trading options, then I would say avoid trading individual stocks. As you can see over here, all these individual stocks, avoid trading them and only focus on trading the index ETFs, or more specifically, just one ETF, and that is SPY, which I have right here on the charts right now. So why do I say avoid individual stocks and only focus on trading SPY? Well, one of the biggest reasons why a lot of people actually lose quite a bit of money when they're trading options is because they're trading on individual stocks. Now, there are many reasons why many people lose money, but one of the common themes that I find is that when people say that they have lost money, usually it's because it's on individual stocks. And the reason why individual stocks can lose you a lot of money is because it's very volatile. Now, a lot of new traders, especially those with smaller accounts, they are really lured to individual stocks because of the high volatility of some of the stocks that they can give. So high volatility gives you higher premium. So that's why a lot of these new traders, they want to get this high premium from these high volatility stocks when selling options, is because they think that they can make much more when they are trading these individual stocks. But what's the point of trading these individual stocks and getting all this high premium when you have trouble actually keeping this premium? So as you can see over here, this is a study done by the Tasty Trade team, and they compared the movement of the ETFs versus stocks. And as you can see over here, the movement of the ETFs is much more narrower. It moves in a narrower range compared to stocks. As you can see over here, stocks, the one in brown color, you can see that the movement is actually pretty wide compared to ETFs, where ETFs stay most of the time within a narrow range. And this is really what we want when we are selling options, because when we are selling options, most of the time, we do not want the underlying to move that much. If it moves too much, especially if it moves against our positions, this is a time where we can suffer very big losses. And as for stocks, there are quite a number of situations where the stocks can have very, very big movements. For example, if there's earnings coming up, these earnings can make the stock move in a very big way, right? It can either gap up or gap down, or maybe when the stock suddenly have a very poor product launch. If they're very poor product launch, then this is also going to drive the stock to have a big gap down quite a lot of the times. Whereas for ETFs, even though some of the components of the ETFs, the stocks, actually have earnings, it doesn't actually change the price movement that drastically compared to the individual stocks that is being affected. So that is why when you're trading ETFs, it's much more control. Now, that is not to say that you should never trade any individual stocks. What I'm trying to say is that maybe at the start, just focus on SPY first, get your grounding correct, get a little bit of that consistent wins going on. Then after that, you can put a little bit of your capital into individual stocks and see how that goes. But at the start, trading just SPY can really help your performance, especially with your confidence as well when you're trading options. Now, the other reason and more important reason why I say to trade SPY, in fact, over all the other index ETFs as well, is because Tasty Trade already have numerous studies and statistics on SPY that shows that if you were to trade SPY, you have an edge over the long term. That means that you can actually be net profitable over the long term. So for example, over here, this is the strangle on SPY. As you can see over here, SPY 16 delta strangles. You can see that over the long term, ever since 2005 thereabouts, all the way to even past the pandemic, it has been net profitable. So regardless whether you exit at 21 DTE or whether you exit expiration, it is still profitable. Now, that is not to say that you won't suffer any losses or you won't suffer any big losses. All this is just part and parcel of the game. As you can see over here in 2008, when there's the financial crisis, SPY went down a lot. But the strangle, although you lost money, it's not that big compared to SPY. And if you were to see somewhere in 2020, there's a big drop. So this is one of the times where you can suffer a huge loss, but that is not to say that you will not make money over the long term. So the key down here again is over the long term, and also really to exercise proper money management. When you exercise proper money management, you won't let any single trade wipe out your entire account. If you're at the point whereby one trade wipes out the entire account, it just means that you are risking too much on one trade. Now next, as you can see over here, this is the Iron Condor. So the Iron Condor, again, this study down here is done on SPY all the way back to around 2006. And as you can see over here, over the long term, same thing. If you were to exit at 21 DTE, you're going to be net profitable. If you hold to expiration, your performance is not going to be as good. But again, hey, over the long term, you're still going to be profitable. So if you have been losing all the time trading Iron Condor, maybe you have been trading Iron Condors on individual stocks, then maybe you might want to consider trading it on SPY instead of individual stocks. Now, next, this is the short put. So as you can see over here, same thing as well. Over the long term, it's going to be net profitable, regardless if you exit at 21 DTE or hold all the way to expiration. Here's another strategy called the Jade Lizard. So the Jade Lizard, same thing as well. You can see that over the long term, it has been net profitable, again, regardless whether it's 21 DTE or whether you hold on to expiration. And finally, the ever popular put credit spread. So if you have been trading put credit spread and you have not been profitable so far, and I know this because a number of people have actually emailed me to let me know that, their performance on put credit spread. A lot of times this email which I receive is on individual stocks. So again, same thing. If you have been struggling to be consistently profitable when trading any of these option strategies which I've shared here, then try it on SPY. Now at this point of time, you might be asking, but Davis, if SPY is profitable, why don't I just buy and hold SPY? If I just buy and hold SPY, I'll be profitable as well. Why do I want to trade options on it? And that is a very good question. And there's really nothing wrong if you buy and hold SPY, because it can make part of your portfolio as well. And I do encourage you to have some long-term holdings in this index ETFs. But if you were to compare options with buy and hold, you can actually have a better return, a better result if you trade it correctly. For example, as you can see over here, this is a very simple put credit spread strategy on SPY, which has done much better than if you were to buy and hold SPY. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So as you can see over here, the underlying here is SPY. And we just go with a very simple put credit spread strategy where you sell the 20 delta and then you buy the 10 delta put, and then you exit at 21 DTE. And this goes past 5 years. So all the way to the beginning of 2020, all the way through to the pandemic. So as you can see over here, the total profit and loss by selling this put credit spread is $13,629. But if you were to just buy and hold SPY, as you can see over here, they compare it to SPY, you would just be making $10,153. And if you were to see the return on the right-hand side over here, you can see that the return is 114.54%, whereas if you were to compare to buy and hold is about 85.32%. So when you are trading options, it only makes sense that you should get a better return than buy and hold SPY. Otherwise, there's no point for you to trade options at all. So with options, if you trade it the right way, you can have a better return than if you were to buy and hold. But of course, there's always a trade-off. So this is something very important to understand, because when you're trading options, options is a leverage tool. So although you can get a higher return, one thing to understand as well is that you can also suffer a higher drawdown. So as you can see over here, your drawdown when you're trading options is about negative 37.42%. But if you were to buy and hold, your drawdown is negative 34.1%. So your drawdown when you do the buy and hold is slightly lesser than when you trade options. But in this case, in this strategy, the drawdown actually is not that much worse compared to buy and hold. So actually it's not too bad. So this is the reason why we actually want to trade options. But of course, like I mentioned earlier on, that is not to say that you shouldn't have buy and hold in your portfolio. You can definitely allocate a part of your portfolio to buy and hold, and then some also to trading options. So now that we know that if you want to have a safer way to trade options to be consistently profitable, we should be trading SPY. So the question now is, what option strategy should we trade on SPY as a beginner? So far I've already shared with you quite a number of strategies. So the first one is the Strangle, second one is the Iron Condor, third one is the Short Put, fourth one is Jade Lizard, fifth one is the Put Credit Spread. So out of these 5 strategies, which one should you try and focus on at least at first? So my suggestion is, if you don't have that big of a capital and you want to have a relatively safer strategy where you don't have to worry about unlimited losses, then that would be the defined risk strategies. And mainly I would say focus on just the put credit spread. And this put credit spread, why I would say is very suitable for beginners, because if you think about it, if you take a look at SPY, SPY is a positive drift vehicle. What it means to say is that over the long term, SPY just wants to go higher. And if you were to take a look at the long-term chart, let me just zoom out to the weekly charts and let me just remove all these drawings. You will see that SPY, for the most part, just wants to keep going higher. So if it wants to keep going higher, then it only makes sense to just put on a bullish strategy. So the bullish strategy in this case would be the put credit spread. So in a lot of the studies which I've shared with you earlier, basically the Tasty Trade team, what they did is that they put on the strategy, and once they close out the trade, they will put on the trade again, right? So as you can see over here, this put credit spread performance, this long-term performance over here, is once you close out the trade. So let's say, for example, you want to exit at 21 DTE. Once you close out at 21 DTE, you immediately put on a new trade again. So when you do this, what happens is that, for example, if so happen that at the point of 21 DTE, the market is at an all-time high and you close out the trade, let's say over here, you will be required to put on a new one again. So at this point of time, a lot of people actually struggle to put on the put credit spread because the put credit spread is a bullish strategy and the market has already gone pretty high. So a lot of people kind of fear entering into this trade of the put credit spread when the market is making new highs. So what can you do instead? So if you're the kind of person that you don't feel comfortable putting on the put credit spread when the market is at an all-time high or is going higher, then what you could consider doing is to add one indicator which is called the stochastic indicator. So let me just show you the stochastic indicator. So as you can see over here, what I have at the bottom down here is the stochastic indicator. Now, you can use the RSI if you want to as well, or any other indicator that helps you identify, overbought or oversold conditions in the market. You can definitely use them. I don't think there's necessarily one indicator that is better than the other. It's just that I have been using this stochastic indicator for the longest time. So I'm just very used to using this stochastic indicator. So if you want to use this stochastic indicator as well, then let me just show you the settings for this. So as you can see over here, this is on TradingView. So you can just set it up on TradingView. TradingView, you can just set up the free account. There's no need for you to pay to use some of these indicators over here. So as you can see over here, the input that I use is 1033. If you want to follow along, you can follow along as well. But if you have your own input, by all means, you can use that. Again, I don't think it's going to make a huge difference. And then for the style, I just use the percentage D, right? I uncheck the percentage K because I wanted to make it a little bit more neat. As you can see, if I put the percentage K, it's going to have 2 lines. If I just remove this, I'm just going to have 1 line. So for my purpose of using the stochastic indicator, it's actually very simple. Once it goes to this red line down here, once it goes below where it becomes an oversold reading, this is where you can consider getting into the put credit spread. So what is the delta you should put and how should you construct the put credit spread? I've already created numerous videos on this, especially I have an ultimate guide on this put credit spread, or rather for credit spreads in general. If you don't watch that, just go to my channel and look for that video. I'll put a link at the top right hand corner of this video as well, so you can go ahead to watch that at your own time. So how do we use this stochastic? So it's very simple. As you can see, first thing, why does it make sense to use the stochastic indicator on SPY? Because again, SPY is positive drift. It wants to go up over the long term. So we want to identify points where the market has retraced to pretty much an oversold condition, and then we enter our put credit spread. So as you can see over here, here are a few times where the stochastic indicator has indicated that it's oversold. And if you notice, this actually coincides with the market making some sort of a retracement, and then eventually the market goes back up again. Same thing over here, slight retracement, and then it goes back up. Over here as well, you can see that the market has retraced. Then after that, the market would eventually go back up again, right, in the long term. Now, that is not to say that this indicator is perfect. It's not that every time it goes to the oversold region, then you are going to be profitable all the time when you sell the put credit spread. That is not true, because there will be times if the stochastic indicator shows an oversold reading and then the market goes down, it can continue to go lower again. Now, of course, in this example, you can see that market eventually recovers and go back up, and likely you'll be profitable with the trade. But it won't happen like this all the time, because back in 2022, there'll be times where the stochastic indicator will show an oversold reading and then the market continues to go down. So you will definitely have losses. So the most important thing is to have proper money management. That means to say you position size each trade well and do not risk too much on each trade. You do not want to risk your whole capital, that's for sure. Now, trading this way, over the long term, you will be profitable. But of course, as you know, because we're trading this on the daily chart, as you can see over here, I'm just using the daily chart, you won't have too many opportunities. But hey, at least you will be net profitable over the long term compared to if you were to trade all these individual stocks over here. So if you want to have a much more consistent result, and especially if you're new to trading, then you want to focus on SPY. All right, I hope this video has been helpful for you, and if it has, I would greatly appreciate if you give me a thumbs up on this video and also subscribe to get more videos like this, and I will see you in the next video.